All right, let's talk markets this morning. Joining us is Barry Knapp. He's managing partner and director of research at Ironsides Macroeconomics. Barry, what are you thinking about the markets right now? What are you thinking about the economy? What do you think about tech spending?
Well, I'm pretty negative, at least for the next couple of months, for the market. Fairly negative for the economy, and reasonably positive for tech spending. So I think that's probably the only decent part of the economy, or really the only decent part of the economy right now. As far as the whole market setup, to me, the fundamental backdrop, the earnings story looks fairly weak right now. We did have a strong earnings quarter in the second quarter, but we were comping against the low point for the three-quarter earnings recession we had, which was the fourth quarter of 22 and first half of 23. Earnings are only expected to be up about 5% or so in the third quarter. Ex-tech and communication services only about 2%. And when I look at revisions for each of the sectors, net revisions, the number of analysts increasing estimates less those decreasing estimates, they're going down fairly sharply, including for tech, and in particular for consumer discretionary, which sort of tells you, you were talking with Contessa about Foot Locker earlier, and Target, Walmart all had what looked like decent results, but the estimates aren't going up. They're actually going down for the most part. So that fundamental backdrop really concerns me. But the thing that concerns me the most is the labor market. I was kind of surprised how many people just brushed off that big downward revision to, the initial benchmark revision to payrolls for the year ended March. I've been expecting that. We were thinking it would be something like negative $1 million. If you just apply that growth rate to the small business component of employment, which of course they guesstimate every month using the birth-death model, you have employment growth below 1% now for the private sector. The last three times that happened, in 90, 2001, and 2007, we were either in recession or on the verge of recession. When my basic premise here all along has been that the way the Fed conducted the tightening, passive QT and aggressive rate hikes, meant that they had to hike rates further than they would have had to do otherwise if they'd been a little more aggressive selling off some of their bond purchases. That caused this steep yield curve inversion that put all the burden of weaker demand on small businesses. They finance at floating rates. They get their money from small banks. And the small business sector is really struggling. You see it in the ADP numbers where small business employment is growing basically 0.1%, whereas large business employment is growing much more rapidly, like 3%. So I think that underpinnings of the U.S. economy are really weak. It wouldn't shock me if we were in recession by election day. Now, maybe we avoid it, but the Fed certainly got to get started with aggressive rate path to get.
Sure. Aren't they riding to the rescue now, or you just don't think what they're going to do is going to be enough?
Well, it's going to take time, right? Because if we're talking about the small business sector, they really need to cut rates aggressively. I recall having a conversation with a woman that runs a ski wear company up the street from me, purely anecdotal, but she asked me at the beginning of the year, how much would the Fed cut rates? And I said, probably 1%. And her response was, big whoop. That's not going to help me all that much, right? To carry her inventory and all. So they really do need to get that policy rate down to 4 very quickly, disinvert the curve, help the small banking sector, help the small business sector. And, it's not clear they're prepared to do that. Now, yesterday's Conference Board consumer confidence, the labor component of that, implies that the unemployment rate's going up again this month, probably to 4.3, with the U6 underemployment rate getting closer to 8%. That'll probably be enough to get them to kick off with a 50. So that's a good start, and maybe we can narrowly avoid a recession. But, to me, that labor part of the economy just looks really weak here. And I'm kind of surprised. I mean, the Fed's woken up to it, but not all Fed members.
Barry, so let me just run real quickly. We're out of time. But yesterday we were speaking with Roger Ferguson, the former vice chair of the Fed. He thinks the market may be over anticipating what the Fed might do. He's looking more at 25 basis point cuts and kind of taking a look around to see how those work before the Fed does anything. If that's the policy, then what?
then I think that the economy has a greater probability of going into recession. I think what they should do would be to go 50 and use the summary of economic projections, their forecast, to say we're probably only going to 4. That way they can temper. I think what Roger's concerned about is the market getting concerned, market getting ahead of them and thinking they're going to have to cut all the way to 2.5 or something. But they really do need to start aggressively to head off the problems in the small business sector.